We all know the rising inflation and skyrocketing interest rates have played a huge part in the steep decline of the housing market. Mortgage rates were near record lows just a year ago as home prices skyrocketed. But now interest rates are playing around 7% and home prices have increased by nearly 40% since March of 22. Consider you have a $300,000 30-year fixed rate loan. At 6.5% interest rate, your monthly payment will be just under $1,900 a month. Over the course of 30 years, you'll pay nearly $683,000. In other words, you'll pay more interest than your home was originally worth. However, at 3%, your monthly payment is close to $1,265 a month, or just over $455,330 over 30 years. With such low interest rates, you'll only pay half the initial value of your homes in interest. The difference between last year and this year in terms of interest rates is mind-boggling. Typically, when rates go up, home prices fall to compensate. Unfortunately, this was not the case in 22. One of the primary reasons is a simple matter of supply and demand. Home sales will plummet to their lowest level in at least a decade. Well, moreover, home sales will fall by 16% in 23 to around 4.3 million. Newly constructed homes are also expected to fall by around 20%. This would result in the lowest level of home sales since 2011, with 32 out of every 1,000 households expected to sell by 2023. Mortgage rates will also fall. To be specific, the 30-year fixed mortgage rate will gradually fall in 23, with the year ending around 5.8%. This reduction could save homeowners $150 a month on a $400,000 home. However, the rate of decline for both inflation and interest rates is determined by how spending and GDP grow or fall in the coming year. Besides, home prices will fall. The average price of a home sold in the US will fall by 4% to $368,000 in 23. Housing will remain less reasonably priced than it was before the pandemic because of high rates and values outpacing wage growth. But that will still be the first annual decline since 2012. If the housing crisis weren't so prominent, prices would be falling more rapidly. To keep inventory low and support prices, the company anticipates a decline in new listings through much of 2023. But not just that, rents will also decline too. High interest rates will make it more difficult for homeowners to buy and sell homes in the single-family housing market, which could lead to an increase in the number of single-family rentals. While multifamily construction is at a 50-year high, hundreds of thousands of new units will be added to the market by 2023, as multifamily units become more economically feasible for builders. Compared to single-family units, the growth trend will probably continue. In conclusion, the current housing market is hurting more than just buyers. However, in that regard, a slowing housing market may actually be good news, as it gives investors the chance to invest for less money. Alright guys, thanks for watching my video. Got any questions, leave it below in the comments and give me a thumbs up and I'll see you in the next video.